I quit my last job before StashAway in October, nearing the end of the whole year for bonus.
Oh.
How much bonus do you have to give up?
I mean, we're talking about 7 figures.
Hi everyone, welcome to Hatch and Hustle, a podcast where we talk about all things entrepreneurship, startup, and share some of our craziest experiences. On today's episode, we have co-founder and chairman of investment committee of StashAway, Freddie, together with us, and we'll be talking more about personal finance and running a fintech company. So hello Freddie, thank you so much for joining us on today's episode.
Pleasure to be here.
Yeah,
Thanks
we're
for
so
having me.
excited to have you. And I'm just really excited to learn more about this because I have no sense of personal finance. I'm just gonna put it out there, disclaimer, I am I'm the youth that is still learning a lot about finances.
You're in luck.
Yes.
Freddie is a very experienced money
Front
manager.
row seats.
And I've worked with him. I've seen how he operates, smooth operator.
Don't raise the expectation too much.
Tell us more about yourself and StashAway.
I'm 45 years old, so one of the signature moves I did was to co-found StashAway when I was 38 years old.
Wow.
I still wish I did it earlier, perhaps when I'm early 30s, because it does came with more baggages when you are starting late, right? So that's one thing about me. I'm a late starter in terms of entrepreneurship. StashAway was my first venture. I did it with care and passion for 7 years. That's a brief intro. And as you know, StashAway is the first digital wealth management platform in Singapore that's now operating across 5 countries. We're in Singapore, we're in Malaysia, we're in Thailand, we're in Hong Kong, we're also in Dubai. We've been around for 7 years now.
Wow.
What were you doing before StashAway?
As you get older, the resume, the list gets longer too, right? But I'm always a finance industry professional. I think I remember I started first in Japan. And that was in year 2000, right in the middle of the tech bubble bust. And I was hired into investment banking of Lehman Brothers.
Which is no longer around.
Okay.
Disclaimer, I left Lehman way before way before 08. Yes. I believe I was at Morgan Stanley. So yes, right. I'm a mascot for what comes next. So that was my first start. It was a very quantitative position because I was dealing with bonds and derivatives and crazy option structure. So because my training was in mathematics, applying mathematics to life sciences. So that before you call it machine learning or data science, we used to call it econometrics, statistics. And so I was deep into those things. So that was my first foray. And then I got itchy after doing a lot of research on markets for a while. And I became a trader on a huge trading floor where you have an L-shaped floor with 500 people on steroid, right? You got someone who was like 6'6" and who climbed Mount Everest 3 times, and you were haggling prices with them on the floor, right? So that was the environment I was in because the technology was still not very advanced at the time. We're still dealing with dot matrix printers, right? So that was the year 2000. Lehman, then became Merrill Lynch, then Morgan Stanley. Most banks I work with except Goldman Sachs. And I'm a Malaysian, so that's kind of nice. Because
Yes.
So how do you kind of move from banking to StashAway?
Maybe Freddie, like what did you have to leave behind when you started your StashAway?
I think I can answer these two together. There's a lot of push factor first. Banking regulation toughened up after the 2008 crises. People were seeking scapegoats and also regulations are getting a bit more stifling, right?
Yeah.
To get things done. So there's a lot of push factor. For example, I'm a supervisor of a whole team. If one of the employees had conducted a fraud, you as a supervisor would be responsible as well. So there's this monthly attestation that they make you sign every year, every month. They can con you years later, right? So you started thinking, hey, is it worth continuing in this position on this side of the industry? And then at the same time, you keep watching people innovating on the side, right? All this fintech starting to become a word. At the time, I was just like, yeah, these guys didn't really know finance. They're really tech fin. They're not fintech. And
Good distinction.
right? And then you start getting a bit of an itch, like, I think I can do it too. I think I can do it too. Then that became such a strong pull factor. After some time, I quit my last job before StashAway in October, nearing the end of the whole year for bonus.
How much bonus do you have to give up?
I mean, we're talking about 7 figures,
Ooh.
7 figures of just bonus alone?
US dollar equivalents.
Oh my god.
Jeez, that can fund
There's
like
a lot of conviction there, man.
that can be like a seed round funding rate.
Exactly.
Not even including his base pay, huh?
But,
So what was the process like and how did you feel?
no, it was just exasperation. You were so fed up with what's happening in big institutions and you're seeing all the stuff that's happening out there. You knew that if you keep thinking about your next bonus, you never leave. And then there's vesting period for the new shares they award you. There's a clawback period. There's all this lockup period for whatever they pay you in bonuses. You know you will never leave if you keep thinking about that, right? So I got so fed up that I quit in October. Quit first without knowing what to do. Just quit. And then started brainstorming ideas and hiring people to brainstorm ideas, to design interfaces. But it's because of the effort. Being in the community, like, you're hiring programmers, you're hiring graphic designers. But because people talk in the community, eventually I got introduced to my future co-founders.
Oh.
Yes, because I made the effort to leave.
But also because you're well known in your space, right?
I hope so.
How did you adjust from such a big organization, a very structured environment, to something where it's a blank canvas?
It's funny because you have a tendency to dress overdressed. So you use a wear jacket and a tie, right?
Yeah, that's right.
So I downgraded a little in the early days, so without a jacket, still with the long sleeve shirts, right? Sometimes with cuffling and nice watches, leather shoes.
Still a finance guy at heart.
And the young people laughed at me in fintech, so I got to adjust further. So today, this is naturalized version of me.
That's true. Like if you go to like fintech festival and stuff, people are in like their t-shirts with the company logo, jeans.
I was horrified with my first event because everybody was so cool like you guys and like us today, and I wasn't that cool on my first few tries. Yeah. So it's imprinted in you a lot psychologically. It takes a while to lose that jacket.
And actually, it's just more than the dressing. It's really a mindset shift, right? You kind of really think a lot more creatively. You also allow yourself to, express a bit more, because if you are suit tie, you behave in a certain way.
I think finding the right balance when you dress smart casual is finding the right balance is the most challenging. Not too flashy, not too disrespectful, and yet it's comfortable, right? So it took me a while to learn that.
So how did your family and friends respond to your decision to leave your 7-figure job at 38 years old to start a company?
I will quote my wife because she's a bit of a weird case as well.
Okay.
I can't wait for her to see this.
She's in Japan right now, so
You got a lot of explaining to do after this, man. Think carefully.
don't worry about it. Don't worry about it. She's weird to marry me in the first place.
Okay.
So I think she was like, she didn't ask any questions. She just noticed one fine day I didn't go to work in formal wears. So she asked me what's happening. I say, I'm starting something. And then she goes, what's the matter with you? You look happy. You're working harder than before. You were like working late, weekends, you're busy, but you dress casual. But what's the matter with you? You look happy. That was the golden quote. What's the matter with you? You look happy. And you're not getting paid.
Yes.
But I was very happy in the early days. That was the best time in my life. If a toilet is broken, it will not be fixed for, I think I remember it was 2 months.
Wow.
Okay.
You want to move to a new office, you'll be carrying your own printer, your screens. Yeah, I remember. We're just trying to save every dime, right?
Yeah.
Yes.
Yeah.
What was the biggest challenge for you at the first 1 year of building StashAway?
Because we were the first, nobody has launched yet. So it's a proof of concept situation. So when we raise money from investors, we are selling a vision. We're also selling the co-founders. So it's very fortunate that I met my co-founders that complimented me. However cool he was, he just couldn't have a finance guy. It's not enough. Fintech, right? There's a fin and then there's a CTO on the tech side. But who are we serving? Consumers. It's an e-commerce business. So you need a e-commerce oriented co-founder. You also need a tech co-founder. So that was sorted in the first 2 weeks of StashAway.
So how do you meet your co-founder and what sort of qualities do you have that complement each other?
I think the meeting was very interesting too because we were just so vastly different. Michele Valario, he was ex-CEO of Zalora and he was an Italian fashion guy. I'm the jacket, cufflink, Malaysian finance guy, right? And then there's a German, Nino is from Germany. He's never worked for anyone in his life. He's a serial tech entrepreneur. So he built platforms, multiple platforms by now. So how we get together is because I mentioned earlier, I made the effort to be out there alone and I hired people, consultants and designers and just to design a B2B robo. They were thinking about a B2C robo. I wouldn't dare to do a B2C because of my background, right? Because I needed a consumer-facing co-founder. And through Michele and Nino, I have that. And so that was a great compliment and gave me the confidence to just say, hey, what the heck, you only live once, YOLO, let's do it.
Oh, that's cool.
Coming from so different backgrounds, how do you all hash away your differences?
The differences will always be there.
Yeah.
It can never go away. But the thing is that you got to have this principle that you don't have a co-founder to agree with you. The reason you have co-founder or even your employees is so that they can watch out for your back, right? We're missing something that could be fatal, a fatal error. That's why they are there to warn us, to disagree with us. So we agreed to disagree from day one. And then my meeting was like that because when I first met Michele, he was like, Freddie, let's build equivalent to Wealthfront and Betterment in Southeast Asia. And I said, why? Why do you want to do that? The algorithms are dumb. They're very straightforward. Why don't we make it more sophisticated, more deserving of the fees we charged? We got to have intelligence in the algorithm. Instead of being mad about what I just said, he was like, oh, how would you do it? And the 40-minute discussion became 2 hours. We were drawing on paper. We were brainstorming how to do economic regimes, our famous ERAA model at StashAway. And that became a working session. The same thing happened with Nino. So I knew that very early in that meeting, we can agree to disagree and we can brainstorm out and through all that differences. So that's what you need.
Given that all three of you have a lot of successes in your career experiences already and possibly even be okay to retire, what was your why at a point in time to go through so much hard work and 2-hour meetings to be a startup founder?
Quite simple. My daughter was 4 years old at the time, and I was thinking, if daddy is just another investment banker or a fund manager, is that something that she would be, she will be able to be very proud of? I can say today, the end result today, my daughter will call me at times and say, hey, daddy, one of my classmates' parents knew you. They work for Amazon, they work for Facebook, they have accounts at StashAway. I'm so proud of you, daddy.
It's such a nice feeling.
That's such a melty daddy moment, right?
And I think as we discussed earlier, that these are the moments that will help you push through the challenges. I'm sure you've faced so many challenges, but when you think back, having this conversation with your daughter, it gives you the extra oomph to go through.
Especially when in the class, there's a famous footballer and then she's like, Daddy, I think you are the second most famous parent in our class. Second most. I mean, she's not lying. She's technically correct, right?
You made her cool as well, right? She became a cool daughter.
Yeah, so that makes up for all the lost income.
So Brian, how about your daughters? What do they say about you? Are you cool enough yet? Or
Not at that level
are
yet,
they
I
not
guess.
old enough to process what you do actually?
She kind of knows what I do. I showed her a picture of me on the newspaper the other day and she's like, oh yeah, how come you're on the newspaper,
She didn't say you are famous?
I think she kind of knows. Like she was Googling my name one day on the phone. I was I was surprised that she was even doing that.
He's being humble. He must be melting
Yes.
inside.
Dalton's
Maybe,
validation.
So Freddie, how would you describe StashAway in one sentence?
In a nutshell, we are an automated investment engine that's easy to sign up, easy to contribute to, easy to withdraw, and we managed for you a portfolio of globally diversified assets in a click.
And if for those that don't know what a robo-advisor is, can you just describe that in one simple sentence, please?
Basically, you don't have to go to the banks or an office anymore to sign up forms. You can just upload your personal information and onboard yourself to an investment app. A robo-advisor tends to analyze your risk profile, and based on those information you supplied, come up with a portfolio of different combinations of assets that matches your personal background. So that's what's badly missing when we first started StashAway. And today, I think there's still a lot of papers going around, still a lot of physical meetings going around. We have a lot more work to do as an industry.
How big has StashAway gotten?
We were the first robo-investing platform that crossed the US dollar billion dollar mark in December 2020. It was announced in January 2021 with a 1 month delay. And today we are multiple times that. So it's a growing business. However, if you just look at Singapore alone, we have at least $1.5 trillion of household financial wealth that's not served. Not managed by wealth managers, not in the CPF, not invested, just stays idle in the system. We have a lot more room to grow. We have a lot more work to do.
What would you say to people who are skeptical about robo-advisors?
Yes, is the AI safe? Is it going to blow up? That's the first question. Is it going to be cybersecurity enhanced? A robo-advisor tends to start with a risk profiling. And it tends to, so not just StashAway, but a lot of us in the industry, we always talk about know your risk level first so that you don't lose sleep investing. And two, you must have a financial plans. Why? It's better to have savings every month and invest those savings, the money you don't need, and not borrow money to invest, so that the stress level is managed. We also say that so that people don't overreact to short-term ups and downs in the market. I say ups and downs because when things are up, we get a bit greedy and try to keep chasing it. Or when things are down, we get a bit too pessimistic, get too risk-averse suddenly, right? That hurts our wallet as well. So all these are designed to sort of smooth out those emotions. So what a robo does pretty well is to profile you well on your risks and to also advise you through all the education channels that we have, especially StashAway. We have a StashAway Academy. Early on in the day, that is focused on educational efforts, building the community and educating them about first principles.
Speaking of robo-advisory, how is StashAway different from Endowers or Scythe or the others out there?
They are not in the room today, so I wouldn't speak about them without them here, right? But what I can say is versus the industry, the difference is we are the oldest one here. We are the one with the longest track record. So that means that we've been through the 2017 market rout, we've been through Donald Trump's trade war, we've been through COVID, we've been through so many multiple event-filled period in the last 7 years. And we have the track record to show for it. So I think that's the biggest difference. But it doesn't mean that a new robo couldn't do well either, right? Past performance does not indicate that you're going to equally do well tomorrow. So let me just disclaim it. Sound like a compliance officer right now. But we have a track record of going through ups and downs longer than any other robo. We also believed in a more complex, more sophisticated, more thoughtful strategy. It's a lady's name, ERAA, E-R-A-A, Economic Regime-Based Asset Allocation, ERAA. Sounds complicated, so we try not to get into the details. But it's based on economic environment, growth and inflation where they are, and it looks ahead and try to see if we can tweak the portfolio to prepare for those big changes in our environment. Before all of us retire, I'm lumping together the age group. We may go through several more recessions and boom times. The passive investor will say, I forever don't change my strategy. I just don't borrow money, I just keep sticking to it. That's one way. But it can be quite annoying because if you have economic changes that's so big and they are very persistent, they can last 3 to 7 years easily. Even though you say I'm a 100-year guy, I'm a 30-year target, you'll be quite annoyed for a number of years. And once the person's annoyed or challenged emotionally, then you may end up making mistakes. So we felt that it's better to take the middle ground between passive and active. We are not very active, but we're not completely passive. We want to make those strategic adjustments to your portfolio to reflect the seismic changes in the world. Growth, inflation, or whether valuation is too high, or whether you have this AI wave right now, should we join in? We want to make some fine tuning that allows you to participate in those 3 to 7 year big things that's happening around us.
Interesting.
Financial services is a lot based on trust, right? And you're a B2C business, and that's why I think a lot of our cash is still parked with like legacy banks. So how did you build trust around StashAway as a brand in the early days?
I think that's a great question. It was a brainstorming session early on when we founded the company. How do you win trust? And you were the first in this industry.
Like you're not looking at a banker like across the counter. You are like literally putting money in a platform
And
and a
nobody
website.
knows you, right?
Yeah, exactly. How do you know it's not going to be
Our
a rub?
solution was let's get licensed at the highest level.
I see.
That means actually higher than most hedge fund manager out there, actually higher than all of them, because they only serve accredited investors. What StashAway did early days, and we insisted on it, and I'm still so glad we did it, was we went for the capital market services license at the retail level, which means that we can serve anyone, whether you're wealthy or not wealthy, anyone. But that means there's a higher level of due diligence, audits, like periodical audits, there's internal audits, external audits. We must have a compliance team. We must talk to the MAS regularly for approval before you launch a new product, we want to talk to our regulators. Before you go to another country, you also want to, have a conversation with your regulators. We must maintain a healthy balance sheet on our company. We must have adequate funding. We must have extra money on the side that's idle. We can't use it as a backup reserved. So there's a lot of requirement that comes with a CMS retail fund management license. And actually, to your older question on our difference, that actually was our main difference. A lot of the robo competitors didn't launch with that level of compliance. We were the first and only for a while. Today, they all join in the same licenses.
Last year, there were some, reports on your China position. What was that about, and what were your key learnings coming out of that?
That's an interesting one. But I need to step back before the March 2022 episode because we invested in China right around the COVID time. What happened was during COVID, the market crashed as well. We weren't fortune tellers. So we were invested in the markets. But we explicitly quantified the amount of stimulus governments around the world, central banks around the world. We explicitly model it mathematically. A certain amount of money is coming in. And that money is going to multiply in the banking system. We call it velocity of money. Money circulates in the banking system. $1 will multiply after 7 months into multiples. And so we quantify that the US has printed such a massive amount of money at the time that we can have 3 lockdowns, full lockdowns. The GDP has been replaced, 75% of US GDP. So we stay with it, but we were very concerned with the money that's printed. There's so much US dollar going to be around. Maybe US dollar will depreciate against Thai baht, Sing dollars, where our users is Malaysian ringgit, or our users in 5 countries. So we need to think about a currency risk. And we had, at the time in our portfolio, quite a sizable technology investments in the US. So China came in because second biggest economies in the world, they're adopting innovations and applying technology on a grand scale in China at the time. So we were so impressed with China on a grand scale, we actually replaced US technology with China technology because of the currency angle and also because of tech is about the second wave of new growth and China was leading the way. So we got to go back to the drawing board. That's why we were there first. And in 2021, we massively, and even 2020, and we massively outperformed the markets because of China tech. So let's not forget that. However, around middle of July 2021, China decided to embark on a regime change in terms of regulations. There are a lot of societal reforms. They're going to prioritize a bit more social angle rather than just pure another monetary targets. right? So edutech was the first shock where a lot of investors were caught. It was a rude awakening by a lot of people where they decimated the entire edutech industry. You can see that big names are going down from $100 to $2, right, in a month. We also, at a time, have some investments in it, but the noise that's coming in March 2022 was due to one portfolio in particular, the highest risk portfolio on our platform. And by design, that portfolio will have quite a big chunk of allocations to the newer or the most growth-oriented asset classes. And so the noise primarily came on that particular portfolio called SRI36, meaning there's a 1% chance of losing 36% of your money if you choose this portfolio. And you must qualify for it. And I'm glad to say, amid that huge episode on China that we get caught with, that portfolio returned 1.2% positive in 2021.
So that
Didn't
said,
lose money.
what was the learnings, and on the point of trust, how do you...
The learning is that stick to your risk designs. The way StashAway works is always starting from risk first. So what we do is we actually simulated the top 10 painful scenario in history of financial markets. We use that scenario to shock portfolios of all risk levels, and then we say, if this happened tomorrow and we have no time to respond, what is the instantaneous maximum impact on your portfolio?
So how has StashAway performed as a robo-advisor compared to the market?
That's an interesting question. During the last 7 years, plenty of events to talk about, right? Lots of turbulences, but we're very pleased to say that we outperformed the index in all of our years except for 2021. So even for a professional hedge fund manager, that's very difficult to achieve.
Why do you think that was so?
Well,
Because he's very good at his job.
that's a good joke. No, I think it's all about pre-planning. You can never plan your investments to react only when something already happened. You have to budget for all these big waves. So we simulate risks, we simulate the most painful risks, and we make sure the portfolio is designed to weather them. We also do a lot of education and communications with our users and say, please do not borrow money to invest. Please plan your own personal finance as well. That's actually half the battle to investing success, rather than predicting where the market is.
I see some takeaways from all this that you're describing, from managing billions of dollars of AUM down to a personal and individual level as well, like forecasting, pre-planning, and also managing a personal portfolio, right? What do you have to say to like youth, especially who are venturing into managing and investing for the very first time?
To all of you out there, this is a great age to be young. You got all the technological tools at your fingertips. Today, we don't, right? You can choose between different robo-advisors, not just StashAway. So you are the blessed crowd. And this question is great because number one, save. Don't spend more than you can earn. That's the number one rule, saved. If you can have monthly net savings, build that up to a certain emergency fund. It could be 6 months of monthly expenses for younger folks. For someone like me, it should be 2 or 3 years. So it depends on where you are in your life, but build up a safety net. Then invest any dollar above the emergency fund so that this is money you don't need. Ups and downs don't matter. You didn't borrow money to invest. You are staying put with the plans. Didn't matter. Invest on the monthly frequency. Just keep building it up over the next 10, 20, or 30 years. You will end up better than most fund managers out there.
Wow.
I'm going to take this opportunity to ask you some questions, right? So I'm in my 30s and my objective is to kind of accumulate wealth. I'm pretty risk-taking, so I like bungee jumping, skydiving, all kind of stuff. Currently, my portfolio, if you look at it, is 40% public equities, 10% private equity, and then 35% real estate, 10% cash, and then 5% crypto and a wine fund. I don't have bonds in my portfolio. People around my age, how should they be thinking about where to invest?
Actually, the risk level is the question here, and every individual is different, right? Denise may be more conservative than you relatively, say, and let's say suppose you are the same age today.
We're close.
We know there's a margin of error there, but let's suppose we are the same age today, right? But you're different people. You may start with a SI 36 as StashAway. You may start with SI 10. There's no right or wrong answer. That's fine. This is your starting point. But as you grow older into your goal time, you target certain things. I want to retire in 30 years, and now I'm getting older. I'm heading into it. Your risk level should be adjusted lower and lower and lower over time, because the amount of time left you have to recover from surprises is also less.
Right.
Your ability to take hits is less. So you will be SI 20 one day, you might even go lower, right? So there's no right or wrong answers.
So
But
it's risk-based approach.
But generally, as you grow older, your risk level decreases.
yes, relative to your starting point.
So we've been talking so much about money, and Brian, I'm actually really curious, how do we maximize the amount of money that we can make?
I think we make money in two main ways. The first way is actively making money, right? And actively making money will mean getting a job or starting a company. And that is, of course, limited by our own individual man hours. We can only do it to a certain, everyone has certain limited bandwidth. Of course, we can increase our bandwidth by maybe working with more people or hiring people and so on. But basically, this is what is, I would say, is the active way of making money. And then the passive way of making money is then essentially, what you do in the time that you're sleeping, right? Can you still make money when you're sleeping? And that is what I feel investing is all about.
Yeah, I've personally always been really afraid of investing. I know many people my age who have started maybe a couple of years before me, and for some reason I just don't dare to do it. I'm like, yeah, it sounds really good. You make money while you sleep. Sounds too good. Sounds way too good to be
But
true.
why are you afraid? What's driving that?
That's a very good question. I don't know. My parents tell me, they say the money that's in your current bank is just sitting there and it's not
It's
doing.
depreciating even, right?
Sure, I don't really know what that word means either, but it just means like my money's just there, right? And it's not doing anything, so might as well take some of that out. And they're not saying take everything out, but just a little bit and just try. So I haven't started.
What
but,
are you afraid of?
I don't know. I really don't know. Just taking out money.
Maybe a way to get started is to kind of create a paper trading account. So that means you are actually investing in stocks or bonds, and it's not real money. So you can actually do that and try to sharpen your investment thesis, your investment strategy, and your investment skills. So I think that's how I got started. 6 months later, I created a real account. And then I invested and I lost money.
Sorry, I have to jump in here.
Yeah.
I think we got to separate speculation and trade and investing is probably a little bit different.
Yeah, it is.
I believe that a real investor is more passive rather than actively buying stocks, selling stocks, or what have you. And also, it's okay to be intimidated in investing, because that means you can just take a more passive approach, a more diversified approach. For example, if you buy a company that can go bankrupt, virtually go to zero, drop out of the index. But if you're buying the Straits Times index or S&P 500 index, if a company is not doing well, it will be dropped out of that 500 top companies anyway. Something else will come in.
Right.
You will never ever really have those kind of risk
No large.
because and it's very diversified. So there's always a way, depending on your comfort level, there's
Right.
always a way to invest.
And I think you can kind of have that comfort level by kind of risk mitigation. When I lost that, it was a few $1,000s. But it was a very good starting point. And it's just tuition. You got to start somewhere. I think all
Tuition fee.
investors will lose money at some point. I haven't heard one investor who have not lost money before.
Right.
So I think, you can just kind of try, but try in bite size. Yeah.
You know what happens when you do not invest your money?
Do I want to know?
You sound like a dad now.
Yeah, Brian's like,
You were talking to your daughter next time,
okay, no,
right?
actually, I think it's important for me to know.
I think it's important for everyone who is not investing the money to know that if you do not invest your money, you're basically losing money. And you're losing money because of inflation. Right? Because we've all heard this term of inflation. And what does it mean? It means that the prices next year are going to increase. But your money is not going to increase if you don't invest it. So what happens is that bubble tea that you used to buy is now 10% more expensive. And you actually, your money can't travel as far as it could.
And one of the best ways to do that is to kind of help your money grow is to invest.
You have to make your money work, I feel.
Right.
And you can put that in very safe, very low risk instruments. It's better than putting it at, just leaving it in the bank and not doing anything. Because you're then just helping all the bank CEOs make money.
Speaking of inflation, Last month's inflation was 5.5%, and there was a wide range of around 5.5 to 7%. It doesn't really feel that way though. It feels everything is more expensive. What do you think, Freddie?
I think the better question is, how do you guys feel about prices today?
The kopi C downstairs my house used to be like $2.20, and I don't live at a nice area. It's a coffee shop, and now it's $2.70, which is the price of like a shopping
Sounds
mall
like 10%
coffee.
to me.
Yeah, and my rent increased 30%. That was very, very steep.
There you
so
go.
so you feel it in different parts of your life, for sure.
So the CPI, the Consumer Price Index, is a weighted down average of everything, right? It may not directly affect us in our daily lives as relevantly as your chicken rice downstairs, your coffee prices downstairs. So when you say 5.5, but consumer actually felt visibly a significant increase in prices. And I think all of us can agree that easily we can agree with 10.
And we look at the property market, we know that over the years,
Yeah.
rental has not just increased by
Oh,
5%.
Yeah.
It's gone up to like 50%.
In some areas it's doubled. And it scares me now because then I should really make my money work hard.
Or cut back.
Yeah, cut
There's only two ways.
Tough with concert tickets to buy, travel, shopping.
So we definitely have to be investing our money. So what can a beginner do to get started? What are some basic investment principles?
There's two parts of the equation. First part is that you need to invest and compound. As my favorite person in the world said, Albert Einstein, physicist, no investor, the power of compounding is the eighth wonder of the world. He who understands it earns it. He who doesn't and pay high fees, that's called negative compounding. He who doesn't understand it pays it. To compound means you need to have enough time in the market. So you cannot solve your today's inflation problem today. You have to have the habit of saving every moment you can and investing your savings. And then let time take care of it, the compounding.
So basically a snowball effect where you earn interest and then your interest that you earn also earns interest and
That's
it
right.
keeps snowballing.
So the people who does well today and not afraid of inflation are those in 20 years ago when they were younger, they were consistently investing, whether it's buying properties, buying bonds, buying whatever it is, they have consistently have time in the market.
So whether market is bad or good.
Doesn't matter. You average in and it works out for you. And today you won't be worried about inflation.
Yeah, there's a quote which goes something like, it's not how you time the market, it is your time in the market.
That's right. That's right.
Wow.
That's right.
That's why he was a finance teacher assistant.
Now, given that younger people like us, including myself, we may not have as much time in the market as somebody older, then we can only always live expenses, in terms of expenses, a lifestyle one below where I'm earning. That's actually even more important now. Look at, it's so easy now, right? Our credit cards are out there, we're flashing it, we're subscribing to services that recurs in expenses. Look into those things again. What is coming out every month that you forgot about? What subscription you have that you don't need? Really deep dive into your expenditure items, cut back, squeeze out more savings and invest.
Like, that makes so much sense, yeah.
Live with your parents longer.
Yes, as long as I can. Listening to all these thoughts about investing really kind of motivates me to actually potentially start right after this podcast, by the way. But what are some of the mistakes that beginners like myself can and might make?
I think young people just want shortcuts in life, essentially. They want to go and know how to make money fast.
I'm called out.
Because they see their friend, oh, I made 10x on crypto, and then they want to go and jump in on crypto. And a lot of people, I feel, are just looking for that shortcut path. But that's not investing, it's speculation.
Yeah.
And you can see this on Reddit, right? There's this trade called Wall Street Bets, right? But what young people do is, some of them, they would take their American college fund,
Yeah.
they'll YOLO and put everything in like one stock, They'll create like a Reddit trade, and like YOLO, wish me luck, and put a screenshot.
Oh, really?
Yeah.
And my goodness, and most of the time they just lose all their money.
Oh, no.
And when they do win, they do influence people negatively to take that approach to making money, which is a very speculative approach.
So very emotional in some sense.
It's almost like going to a casino and
Yeah, I
gambling.
was gonna say that. It feels a little bit like gambling.
And that is exactly what investment is not, right? This is
Exactly.
speculation.
And I think it's made worse by the crypto. When I saw people, they really kind of set the tone that, hey, you can make money so quickly, not even just overnight, but by the seconds. And I think this is a very kind of bad example of how you can actually make money.
Technology has made this very accessible to young people, like apps like Robinhood and so on. When if used responsibly, I think they're fine, but a lot of times they're not used responsibly.
And I think you also got to kind of look at the right mentor. Because a lot of times people choose mentor and they listen to a lot of financial gurus out there. There are a lot of good ones, but there are actually also a lot of financial gurus who have not actually invested and make money. They make money from selling courses.
Right.
Well, I would just summarize it as don't listen to hearsay. 20, 30 years ago, we just say don't listen to people anyhow, there's hot tips. But today it's get worse with technology, right? Social media platforms, social trading platforms, Reddit and all. Things just pass around when people follow celebrities. I would just say we need to stop being bombarded. We need to just know ourselves and minimize being bombarded by all these technologies around us on certain things in our life. And one of them is financial planning, the other one is investment decisions.
Yeah.
Right? We should never be influenced.
Yeah.
You need to really know yourself.
Yeah, fair points.
So, what if I only start out with, say, a few hundred or even $1,000? What should youths with small budgets start with if they want to begin their investment journey?
Well, if you go to a traditional fund manager, you go to the banks, you're too small for them to care.
Shrimp or amoeba.
And they like the high fees. But today we're blessed with technology, and I would say a robo-investing platform would work very well because in the case of StashAway, for example, and I'm sure it's not limited to us, you can invest with $1. Don't do that, but in the extreme, in the early days when we started StashAway, there are users who really want to test whether they can withdraw that $1 tomorrow. And there was no issue. Click the button and
So they put in $1 and they withdraw.
and the next day they try to withdraw it and they say, wow, all we had is some just small bank-to-bank delay, but it wasn't a StashAway or the robo-advisor delay. So technology has gone so convenient now, even when it has come to investing. So there's no excuses, even especially when you're small. Today, you cannot make the excuses anymore.
So I'm really curious, how does everyone plan or manage their finances?
So when it comes to my investment money, I adopt a portfolio approach because I don't want to put all my eggs in one basket.
Right.
So it's spread out in a few different asset classes.
Okay.
Right. So actually a large chunk of it is in property. It's about 70% actually, and that's because property prices in Singapore are very expensive.
Yeah, very high.
If I could design it in another way, I probably would. But I think property is also a very safe investment in Singapore. The other 15% is in stocks, so these are US equities. The other 15% is in a risk-free liquid asset, which I can easily transact if I need to go and withdraw the money at any time.
Well, for me, I think I've got the objective of trying to create wealth. So I put a lot of my investments into equities, public equities and private equities. So I've got about 50% of that. And then I've got another 35% in real estate, and then 10% in cash and 5% in crypto, and it allows me to have that speculation element.
Right.
I think the fact that I don't know the exact percentages like you guys shows that I'm terrible at managing my personal finance. I need to invest more. I think I'm still sitting on a lot of cash in the bank, which is just deflating.
Same, I guess. Among
Yes,
younger people.
Yeah, so I learned a lot of the investment advice from my former boss. So now I'm trying to push more money into public sector, a bit in crypto, and recently trying to carve out some money for private equity as well.
Well, it seems like I'm the highest risk persona in this room, but not by choice. I have a lot of shares in StashAway.
I'm also
as
a
a company.
StashAway customer, not a shareholder, but a customer. So some money is in StashAway.
Oh, thank you very much. That's very nice of you. If you ignore that portion of my life, I have wine investment as a very interesting asset class.
Oh, really?
That's so cool.
Wine?
Fund. I thought you invested in a wine fund too.
Yeah, but it was like a syndication. So we, like 4 of us, we said, okay, let's put 50K in and put in $250,000. But
they're like whiskey fund now
I don't
and
know
all
as
that.
much as Freddie, it sounds. Yeah.
Yes.
Well, I started learning a lot more about wine and also apply investment concepts in wine down to the chateau level. And
Wow,
I
that's so
managed
cool.
to build a portfolio of wines. that.
In a cellar or like they're actually in the vineyards?
Well, in investing in wine, what happens is the investing bit stays in a bonded warehouse, say in London, and you don't actually move it.
That's so
And the
cool.
wine has a serial number, you can trade them online. So
so
that's pretty cool, right?
Do you drink your own wine? Do you drink your
Yeah,
investments?
when you make money, we have returns to drinks, you can deliver a portion of that, pay the duties, pay the
Oh,
transportation.
yeah.
Just drink a portion of that.
Yeah, and it's like drinking wine for free.
Yes.
It's a very interesting asset class. I think some people also invest in watches, expensive watches as an asset class.
Yes.
Some people invest in physical gold bars.
And I'm pleased to say that there are more and more interesting and useful application of the blockchain in this space now, tokenizations, and allowing access to people who normally wouldn't be able to buy into a wine fund, right?
yeah.
So technology has really, whether there's speculation or not in crypto, but the technology will last longer than investors.
So have you thought of introducing wine funds as a product on StashAway? Because I would love to invest in some wine funds and maybe drink some wine.
Well, I've been working on it for years, but unfortunately the conclusion was that wine's liquidity is not as huge as the S&P, for example, and we're managing a huge platform, so we couldn't really do it in a big way.
Oh man.
But there are platforms out there that is doing it.
So, Freddie, how will you break down your portfolio?
The wine portion is probably a good 20%.
That's huge.
A hedge against
Wow.
global warming, and the rest are actually quite conservative. A lot of fixed D, and also I have a very simple one, VTI,
What's VTI?
a Vanguard Total Stock Market Index ETF that tracks the entire world. For those people who actually is a bit more conservative than me, you can buy VTI and VBND, which is the bond version of it. Basically, it tracks the entire world. It's got like, I don't know, like how many thousands and thousands of names in one. You just need to click a button with a brokerage account, click a button, I want to buy this, and it's done.
Right.
I think the minimum trade size is probably $100. So you can definitely do that by yourself, Denise. So I don't spend time choosing winners or losers.
Do you think that's a better approach?
If you don't have the time to really dig into it, because there's a high hurdle rate for fund managers to actually win every year in and out. It's a very difficult thing to do.
Yeah.
If you don't believe you have the time or even the talent to beat the market consistently, this is better than. So not knowing anything is even better, that's what I'm saying.
Yes.
Majority of fund managers underperform the index.
Right.
In Singapore, we know that the cost of living is really expensive, but what's more expensive is all these big milestones that we have. Like in a few years' time, I probably want to buy a house or planning for a wedding. So what's the best advice you can give people to prepare for all these big milestones?
Well, it's a very tough one if you buy an expensive item like Singapore property, right?
Or even a car is expensive.
But I think you can look at it in pieces. When buying a house, for example, it's the down payment that matters most first, right? So I would say if you can't fund it with family's help
For the down payment.
for the down payment, you most likely need a bank loan. So your first idea is, can I qualify for a bank loan? And then interest rate being higher today than a couple of years ago, you also need to start thinking about the amount of burden per month. What percentage of your income is now going to paying the mortgage.
Yeah.
Treat it like a rental burden. So if you're spending, I would suggest do not go more than 30% of your monthly income on anything to do with rentals or a property mortgage. So if you can find a way to stay within that ratio, you're good with other parts of your life.
So should people be buying or renting property these days?
Again, it's a complex question, right? You may think that if you're renting, you're paying the money away to the landlord and then it's gone. You're never going to recoup it.
Yeah.
But then if the market is at all-time high, you may want to wait a little bit.
Right.
So if you're going to wait 2 or 3 years, you know the rental you're going to pay the next 2 or 3 years is not going to be recouped.
Yeah.
Is that worth the wait?
I see.
That will be the crux of the whole problem.
Okay. Okay.
And if you're willing to, you think it's worth the wait, you think the market is going to go crash and burn or it's going to drop 20%, what's the number to you? Right. And in the next few years, how much rental are you going to pay away? Compare the two numbers, and then you can make a decision.
Interesting.
So let's say I lose my job and I am suddenly unemployed. What is the best way for me to manage my finances immediately?
Before I answer the question, do you want to touch wood?
Yes, all the wood. I touch all the wood.
I always believe that you got to prepare rather than react. So even while you have a job, you need to build up your safety net. If you have a 6 months emergency funds, you won't be sweating now.
Yeah.
But let's say you are there today, what can you do? Well, you need to cut expenses. What recurring expenses you don't need, that's the first place to look at. There's ChatGPT actually is quite useful because somebody has shown me on LinkedIn, they prompted ChatGPT to go through all their finances, credit card subscriptions.
Really?
And in the US, actually, people there's open portal that you can get information. Apps can access those things, right? So somebody actually prompted ChatGPT to the level where it looks into, is able to access his banking details. And ChatGPT starts saying, hey, why don't you call up and cancel this? Why don't you call up and cancel that? That's the first place you should be working on.
Okay.
Longevity, how to last longer every dollar. And of course, try to find a job ASAP.
Yes, of course. Yeah.
Then there's one more, right? Like if you can't find full-time employment for a while, but we are still able beings who can provide a service. Is there a way you can consult? Is there a way you can do, it's a gig economy now. We can offer services somewhere.
Find your skills and figure out how to monetize.
We can advertise ourselves, right?
Yeah.
We can be somebody, like one of my friends lost job, instead of driving a Grab, took up for photography and he's a part-time, he's taking photographs and videos for weddings. And then in the end, it became a full-time studio now, right? You never know.
I know in Asian societies, having debt sometimes can feel like a taboo, right? So do you think having debt is actually bad, and what is a healthy debt ratio?
In general, I think not all debt are bad. If you look at during the lower cost of financing where interest rates are really low, 0.5, it's actually quite a good time to borrow debt and reinvest in somewhere that can return you a higher yield. I think as a rule of thumb, for prudence, we should be keeping about 30%, as Freddie talked about, that you shouldn't be paying for your housing, and you should be like less than 36% with regards to including all your credit cards. As we look at also the interest rate rising today, I would say the cost of debt has also changed. So people need to be cognizant that now it's actually more expensive to incur debt compared to the past.
I think when it comes to debt, basically means you are leveraging on money that you do not have yet, right? You are borrowing someone else's money. And when you borrow someone else's money, you can do a lot more with it, right? You can maybe start a company, right? You can maybe get that car you wanted earlier. So it is, I think, quite valuable to take on debt. You just have to make sure that it's at a healthy level, as you said, Ben.
That's interesting because I've always perceived debt as a bad thing. I've never seen it as a way where you can kind of use it to your advantage.
So I think what we're all saying here, the common thing we're saying here is the burden of the debt is sort of manageable to you on a monthly basis. That's okay.
Yeah.
So when interest rates are higher, we have to borrow less. When interest rates are lower, we can borrow more.
Yeah.
It's not necessarily a bad thing.
Okay, so on this topic of debt and investments, I'm also really curious to know about insurance, right? Is insurance something that we need? Is it important?
Actually, investment and insurance must come together. There's an old saying called buy term, invest the rest. Meaning buy a term insurance, covers you in case you die between now and a certain time. Why do we want to do that? Because our investment takes time to compound and grow. If something happens to us today, we didn't get there.
Right.
However, if you just have insurance without investment, what if you survive your term insurance?
Right.
You survived it, it's worth nothing to you, you don't have investment to grow. So you need both to come together.
I see. Okay, that's interesting.
I think a lot of people don't value insurance until some tragedy happens, to someone that you know and they did not have insurance. And then it's a very difficult situation. And that's when they start getting insurance. So I do think that insurance is 100% important.
Yeah.
But just be careful that you get the correct insurance because there are a lot of plans which maybe are not the best for the end user and you have to do your own due diligence.
Yeah.
Same thing as when it kind of comes to investing, to go and pick the best one for yourself.
Right. I've never seen them as hand-to-hand before, so that's really insightful.
So what financial habits should one develop to become a successful investor? Get
So
the
I think
correct
one way
insurance
to
because there are a lot of
start is
plans
basically
which
by
maybe are
trying
not
to
the best for the
understand
end user and you have
how
to do your own due
analyze
diligence.
companies. And you
Same
don't
thing
have
as
to be
when
very
it comes to
sophisticated.
investing, to go and
You
pick
just
the
ask
best one
yourself,
for yourself.
do you wake up, do you drink a lot of coffee? Do you buy your favorite shirt? Do you like a certain brand of shoes?
Oh, that's interesting. Okay.
And then like, why are they so special? Why is this brand of coffee better than the other brands? And I think, you can try to start from thinking from a very simple perspective on why these businesses are successful. And then from that perspective, you start knowing more about businesses, and you start learning and getting educated along the way. And that's where I think, it's a good principle to always be investing in good companies.
Right. So you can start with your own interests or brands that you frequently purchase from, for example.
Yeah.
Or companies that you think has a competitive advantage. Like they are the, not monopoly, but they have this leadership that's not going to go away. And I think Warren Buffett calls that the moat, M-O-A-T, right? So that's one way. There's so many ways, but you got to start somewhere.
Starting somewhere, that's important.
I think a good financial habit is to limit the amount of speculative percentage that you are using your money for. So, I've also bought my fair share of shit coins and YOLO stocks, okay, which I thought and everyone really thought is going to the moon. But thankfully, it's just an extremely small percentage, so it's always never anything more than 5%, right? A very small percentage where I'm prepared to lose that money. I care if I lose that money, but if I lost that money, it's not such a bad thing.
Yeah, I think speaking of that is more common than ever given social media trends, right? To FOMO buy something, FOMO invest, and just follow people, right? And that's what I did in my early days. I just blindly follow angel investments, blindly follow to buy certain hot stocks, right? And of course, lost some money. And I realized one very fundamental thing that you cannot miss is just to do your own research, no matter whether it's trending on Twitter or not.
And I think the mistake which young people make is that they just put 90% or 100% all in, It's the percentage weightage which is wrong.
Well, there's a saying, I forgot who said that, but the only free lunch in finance is diversification. It's always about right sizing and investment in something. And I think, as Brian has said earlier, a portfolio approach. So you don't let any one egg in the basket kill you completely.
So, I think all of these conversations, I just want to know, how can I retire early? Any thoughts?
Well, there's only two ways. One is that you made it big, you have a big hit, you started something, you were an entrepreneur, and something worked, right? And you really made it big. Or a more patient approach, our topic today. Save up, watch your expenses, invest your net savings, and take a 30-40 year timeline on your compounding path and just let time work itself out. So patience or turbocharged success.
Which do you prefer?
I want turbo.
But having said that, we don't really want to retire anyway. When you do it too quickly, it's actually financial freedom, but it doesn't mean you will retire. You still want to put yourself to good use, right?
Yeah, for sure.
Yeah.
So Freddie, StashAway has raised 74 million so far in equity financing. Walk us through the fundraising journey from day one.
Well, every stage is different. Day one, you are selling a vision. You're selling yourself. So the co-founders and the early employees you have, what's the background? What do we bring to the table?
Just a very strong team.
Yeah, hopefully. But a lot of it actually keeps circulating back to my background. Even getting a license from MAS, the first digital wealth management license, was awarded based on my track record as a fund manager.
Wow.
So we have to make it quite personal in the early days. The angel investors that got on board, they were buying the people. They're investing in the people, not just the idea, not just the technology.
And that was before your platform is live?
Yeah.
Wow.
We have a pre-seed round, which is designed for before we even started launching. And we didn't even have a license in hand to operate, so we were just really selling a vision.
And what's next after the product went live? What's the next round?
What's next is hitting milestones, right? So as any entrepreneurship, you want to plan out as far as you can so that your investors know when you need to raise again, what can they expect over what time. And so they know that you're growing, so they don't mind the dilution of raising again. So we need to keep that in mind. Every time we issue more shares in the future, the investors get diluted. They used to have 10% and then you raise again, now they maybe have 5%, right? So you need to let them understand your journey even before you started. So we plan 5 years out, including all the costs we need, all the potential milestones to achieve. And then once you do that, you sort of put yourself on the table. it's quite open and transparent. The investors can use this months down the line and say, hey, you haven't achieved this, right? So it's full transparency. You need to build trust. You need to hit those milestones. And as you grow older and bigger as a firm and you start hitting those milestones, the comfort level is very different. But now you're raising not from individuals, you're raising from institutions, big companies, big VCs, and why would they invest in you? So this is actually, then it became a very numbers-driven situation as you mature. But all the excitements in the early days.
What sort of numbers, like user number, your performance?
Everything. You also got to plan it down to how you, not just a profit level, you got to plan it down to, is it PC1, PC2? PC1 is basically net profit before distribution and taxes and other, a lot of items before marketing or before. You got to break down the net profit figure and do it over time so the investors know what they're getting into. So it become very numbers driven at this stage.
No, there's something that I feel very strongly for. So when startups these days, they fundraise, they think that it's success and their names are all over media, right? But I think the real success is building a sustainable business model. So over the years, I think somewhat when I speak to founders, they always think that they've reached there when they've raised another big round. It's not another bigger fundraising round. At the
It
end
should
of the
be
day,
about the beginning of the journey, right? It's all about what you built out of this money. and
exactly.
funding.
At some point, any business must be able to break even. That means you don't need fundraising. At some point, you need to get there. And if it's already 10 years, you're still fundraising, it gets a bit stressful and hard to defend unless you're telling investors we're going to go do an IPO.
Yeah.
So we need to plan it out over from day one all the way to day 10 years from now.
As different investors, what are some of the trends and themes that you are currently worried about that's happening in the world?
Well, for start, I think it's inflation rate. We talked about 10% inflation rate. Can I find any other investment to try to beat the inflation rate? Can my salary increase 10%? So I think what really keeps me awake, not just an investor, but a common man on the ground is, can I beat 10%? What about you guys?
For me, it's the impact of AI on companies, right? And therefore, their stock prices as well.
Well, for me, it's about US-China tension, whether that will spiral into a Taiwanese situation, and also, on a related note, Ukraine-Russia has already affected inflation, our food prices and all. So I do care about geopolitical tension, and I fervently hope that they will ease off and get smoothed out over time.
For me, it's looking at investing in more recession-proof businesses, given that I think this is like probably the first recession that I'm going through as someone who just started investing myself and looking to like back companies that I think are more like weatherproof. Going back to you, Freddie, do you think anyone can build a fintech company? And what is your advice for those who are aspiring fintech founders?
Well, I would say anyone with the resilience, the grit, right, willing to put up the hard work and the journey and try to enjoy that wild journey, anyone with that tendencies, sure, you can start any company. And advices for those who want to start a fintech company, well, first of all, talk to your better half.
Back to the wife.
If you can get extended support, family and friends, all the help you can get, whether it's technical help or whether it's even financial help, any help you can get, never be shy to ask about it as an entrepreneur. You got to be very hungry, you got to be very desperate, you got to need all the help in the world you can get.
What is your advice to people who are in their 30s and they're looking to start their company, but they're a bit afraid because of all the current obligations that they have?
It's very tempting when you're in the early 30s, you got some experience, some skill set, and you want to do something with it. I think, however, a lot of things put us down. Funding is number one, but I feel that having the right partners to be co-founders with makes the journey a lot easier and more fun. You're not alone. You have a few people on the same boat as you. They think like a founder. That you are on the same side, which is not you against the world. I think in today's case, every company is more complex than before. We need a portfolio of founders rather than a single founder
Like the metaphor.
to ensure success.
I think I personally learned a lot from just this discussion today, and I believe all of us did as well, and I hope all of you do. Where can people find out more about you and StashAway?
Oh, StashAway, we're in the App Store, whether it's Android, iOS. It's also, as me, I'm on LinkedIn, or you can Google me, you'll find me. Otherwise, through my friends at Hash and Hustle, I'm sure you know how to reach out.
That's awesome. Thank you so much for spending time with us today, Freddie. And I hope all of you have learned something from this really insightful episode today. And if you enjoyed this episode, don't forget to give us a like, comment what you want to see next, and hit subscribe. And also, if you're a company looking to collaborate with Hatch and Hustle, don't forget to drop us an email in the description below. Thank you so much for joining us today, and we'll see you next time. Bye! Something from this really insightful episode today. And if you enjoyed this episode, don't forget to give us a like, comment what you want to see next, and hit subscribe. And also, if you're a company looking to collaborate with Hatch and Hustle, don't forget to drop us an email in the description below. Thank you so much for joining us today, and we'll see you next time. Bye!